The last 12 months for Indian markets have been full of twists and turns. When we started the Samvat year, there was a grand promise. But somewhere, Indian markets, they directionally lost their way in middle of the year. Globally, concerns kept on mounting. China once again emerged as the center of volatility. Locally, even though the macro situation is solid, earnings are yet to pick up. So what really could influence your money, your portfolio over the course of next 12 months? And what are some of the key factors which could have impact on your money? So to discuss these factors and then the bull and the bear case for some of these factors, I have with me two market mavericks, Samir Arora and Shankar Sharma. Gentlemen, thank you for joining us and happy Diwali to both of you.
Happy Diwali to you as well.
Happy Diwali to you and Shankar and everybody else.
So the first question which I want to discuss and debate, Samir and Shankar, with you is that US Fed in all probability will move in next 2 to 3 quarters. What will be the implications of that on global liquidity? Shankar, what is your sense?
My take is, the Fed is totally confused and, whatever one hears from them and has heard from them in the last at least 3 FOMC meetings is just all over the place. And, I think now kind of they took a position a few months back that the US economy was in good shape and hence it's time to raise rates. In reality, it is not as strong as what the data suggests because there's enough negative patches in the landscape for us to reconsider a bullish view on the US economy, which the Fed understands. But it has been a classical doublespeak by the Fed that keep talking about a big strong recovery in the US economy, but on the rate front don't do anything. So, the headline that you will keep putting out is the US has recovered very well, it's going gangbusters. But you know what? There is something in China which prevents us from raising rates. There is something in Asia that prevents us from raising rates. There is one little data that we saw in the US that has prevented us from raising rates. It's a very classical, doublespeak being practiced by the Fed. I think they pushed themselves into a corner. There was no real need, in my view, to even talk about raising rates because raising rates obviously implies that growth is strong and more importantly that inflation is going to come back. I mean, so far there is just no indication that inflation is coming back in any meaningful way. And on the other hand, I think there is enough case to be built that, the yields in the US Treasury can actually head lower. So I don't see what is the case to raise rates. I would be very surprised if they actually raised rates. But even if they were to my mind, the market trajectory is more or less certain on a global basis. What that is, I'll talk a little bit later in this show.
Samir, do you agree with Shankar that Fed for the moment is confused and we should not be really focusing on when Fed would move, but if at all Fed would move next year?
True, I don't think it matters broadly to at least equity markets worldwide. This is because if you see the history of the last 7-8 cycles, the first few interest rate hikes up to maybe even a 1% cumulative hike broadly is reflecting more a strength in the economy rather than any weakness or an attempt to sort of slow down that economy. And therefore, from a confidence point of view, I don't think the world's confidence will be shaken because you have 1 or 2 interest rate hikes. As far as India is concerned, because I guess we are all relating to India, we've anyway seen very, very muted FII flows this year, less than $5 billion against a normal maybe $15 to $20 billion per year. And the money that we have seen, some has gone into fixed income, but that is also a little bit reflecting liquidity, but also otherwise reflecting a new asset class. So it's not only that because we have got these fixed income flows because interest rates are low, but it is because this is a new market for fixed income investors. And the other money that has come in mostly into private equity and internet space with a 4, 5, 7 year horizon, I don't think is coming on the basis that current rates are low. So India has already seen some impact for various reasons, not necessarily related to interest rates, but the flows in equities are too muted to have a very big negative, even if there was less liquidity next year in the world.
Samir, the next question which I want to throw open to both of you is, will China remain the center of volatility for next 1 year? Samir?
No, first of all, I think that unless China crashes, it is irrelevant for stock markets at least, or even for economies in US and Europe. Look at it differently. In the years when China was growing well, that is, let's say 2004, 5, 6, 7, the US GDP growth was still only 2.5%. It is not that China contributed to the growth of economies in US and Europe. Mostly it helped the economies of maybe Brazil and Russia and maybe Australia and maybe even Germany, because they were buying capital goods in a big way from Germany. But they merely substituted the growth for other markets like US. So let's basically look at US as the big ship. For US, China is just a supplier. And therefore, if your supplier has a problem, but it still continues to supply beyond a point, you don't care. Also look at it differently. In the 90s, when US had, what the go-go years of growth, there were problems in Japan, there were problems in Russia, there was the Asian crisis, but US continued to do well. US only is concerned with itself in terms of consumer, its own real estate, its own capex. And so I don't think that China can broadly derail the growth in US and in a similar sense in Europe. But unless it crashes, then we've seen that even a small country matters. But if it just has an orderly, slower growth, I don't think it hurts the world in any way. It broadly helps the world because of a lower demand for commodities and a generally more balanced world. So I don't think that China is going to be a negative for the world.
Shankar, do you agree with Samir that China is important, but China is not the be-all and end-all for global financial markets?
I agree and I disagree. I agree in as much that China doesn't matter for US macro growth. But in my view, China definitely matters for US corporate earnings growth. And I can reel off company after company for whom the incremental sales growth numbers, profit growth numbers have come from China to a very large extent. I mean, and Apple is only one case in point. There are literally dozens and dozens of companies which derive incrementally big chunks of their revenues and therefore profits from China. If there is a genuine China slowdown, which is talking about, if you talk about growth rates of 2% or 4%, then you're talking impact not on US macro but on US micro, which is corporate earnings. I think that is really significant to as far as looking at the China impact is concerned. So yes, on the macro, no effect, but on the micro, on company level profitability, whether it's for Europe or whether it is for American companies, I think there's going to be a significant effect for of a China slowdown.
Do you think in this Samvat year, 2072, Shankar, Indian markets will make a decisive new high?
I don't know why you keep asking these kind of questions, because this is like making predictions on election outcomes. I mean, we have no clue whether it will make a new high or not. We can only talk directionally which way we can see the markets going. And given what we see, I mean, it is one of those rare occasions when I'm not clear at all, to be honest with you, whether we are going to go up sharply or going to come down sharply. And the reason why I say this is very simple, that if you look at the fiscal numbers, they look quite okay, but if you talk to companies, they're all dismal. And I'm unable to reconcile the two very differing positions on this. And if you talk to companies across the spectrum, I'm talking large companies. Smaller companies, of course, are in different league altogether, and I've liked them as an investment space for nearly a year now. But talking large companies, they are not seeing any tailwinds which can propel them to achieve double-digit growth comfortably. So there is a disconnect, and that is what is making me a little reticent in making a straightforward case that we are going to go into a breakout into a new high or crash down to 20,000 Sensex. So bear with me. This is one of the rare points which I'm still thinking through.
Samir, what is your sense? Do you think it's difficult to make a case that Indian markets will make a decisive high next 12 months?
Well, if you talk about the index, I agree, because even if you look at the 90s, where, obviously there was liberalization going on, and therefore when I was in Alliance, we would say that the market has gone nowhere, but we have made some X% return. I think that situation is back in a different way. That is not, in a sense, you can call it because of liberalization, but this time it's more to do with massive change in trends, whether it's in commodity companies or whether it's in real estate companies or whether it's an attack on black money or whether it is because the large groups are all leveraged. But I don't think the index is going anywhere. And the older groups, I think each and every one of them, I think without exception, will have some absolute, not blow-ups, but near disasters in their portfolio in some company or the other. And therefore, I don't think the index is going anywhere. So, whenever, please remember, whenever anybody comes on a channel and says that this is a bottom-up market, it broadly means he's bearish, but he thinks that he can select some stocks better. And I would think right now it is a bottom-up market.
Samir, but Shankar made an interesting point, which is macros for India are looking great. Micros is where the problem is. And this is the reverse of what we've seen and what we've reported in last 3 years. For the strongest time, the India pitch has been poor macro and great micro. Earnings recovery are not there, Samir.
But that is actually the reason. The reason why we have good macros is why we have bad micro. Because when we have good macro, when we say that, commodity prices are down, therefore many of our commodity guys are begging every day for higher and higher protection. We have good macro because we say that the fiscal deficit is, let us say, in control a little bit. And therefore, that we are trying to actually, as a government, trying to raise money from everybody for giving them spectrum and coal. In the past, because those were gifted to these corporates, it looked like good micro. It's basically the same thing, that in a sense the government has taken away the gift, which either because of global prices or because of having these things being sold at throwaway prices has no longer the case. And that's why I feel that the market has become tougher, because nobody can claim that he's got a gift because he knows somebody or he was first in the queue and things like that. So the good macros and the poor micros are connected to each other.
Shankar, as an investor, are you disappointed with government action or government inaction?
Look, I mean, to be honest with you, if you go back from 2003-4 onwards, my bullishness for a while, which was about, I think, roughly 2.5 years, didn't stem from anything I expected the government to do. I'm a big believer in global trends. I mean, I rarely believe that a human being and a single human being can alter the course of, large countries and large economies. I mean, all those things are stuff of fairy tales. I mean, I never bought into this whole myth about a single person coming and changing everything. I thought that was a very childish view that almost all the street had. Irrespective of how well-intentioned that person might be, it is impossible for one person. I mean, even a company cannot be built on the basis of one person, let alone a country. So I take nothing away from, the good intentions of the previous government or this government. I think both of them have been very, very well intentioned. But you need, for large economy like India, a big, strong global tailwind of growth. And that clearly isn't there. I mean, it's not rocket science to figure out, and the world is struggling to get to 2%, 3%, 2.5% kind of growth numbers. We keep airily talking about 8% and 10%. I mean, which world are we living in? I mean, look at our export data, look at our IIP data. I mean, the IIP data is supposed to be good if it goes to 3%, because that has grown from 1.5%. It's all ridiculous. So, my point is that I'm not disappointed. It is very well in line with my expectations. I didn't expect any miracles, and I've got no miracles. So that's pretty much where it is. Now, every government that comes in will have some new program or some new, twist in the tail that I will launch X scheme and Y scheme. That every government in the world does it. Every government in the world comes to power on the basis of attacking the opposition. Every government that comes into power promises jobs, and manufacturing jobs in particular, which is exactly what this government has also promised. But almost no government delivers on this promise anywhere in the world. So why should I be disappointed? I mean, it's exactly as per what my expectations were.
Samir, what is your sense? Shankar is of the view that he's not disappointed because he was not expecting anything.
what I tell investors, and in a sense how I think like this, is that India's weightage, for example, in the world is 2%. So any large investor we meet normally will give his India allocation to 3 or 4 funds. So they'll put 0.5% out of their 100 with one fund. And I told one of them recently that you have allocated money to our fund after 1.5 years of talking and then visiting our office and then me visiting you twice in US. So for a 0.5% shift in allocation in their portfolio from one fund manager to another, effectively, they took 1.5 years, and then they asked me what Mr. Modi has done in 1.5 years. So I said, look at how decisions are made. To do this interview with you, how many times have there been back and forth calls and change of time and change of shift, change of day, and whether it'll be in the morning or evening, whether in my office or in your studio, to make one interview of 25 minutes. So for us to expect that India will change, what has happened is that India, without this change or without new things, has always been a very good performer as a stock market. And my one line point for that is that for the last 19 years and 9 months, which is from December 31, 1995 till today, the Indian market, not fund managers who may have beaten the market, but our Indian market in dollar terms has beaten Berkshire Hathaway. GST in these 19 years and 9 months, we did not have a land acquisition bill, and we did not have many other things, but we had that return, and those kind of opportunities will always be there and are there. What the government does is an add-on, and we hope that it does faster. But in 1 year, they could have started a few more things and got a few more things going which people would have been excited about. Right now, what has happened is the whole world only asked 2 questions. Will GST bill be passed in this session of parliament or not? As if that is a single factor, this thing for the world to focus upon. So I don't think we are disappointed, but yeah, they could have done a few things a little faster. They could have solved some tax issues a little faster. But I don't think beyond a point the market should wait for them to change or not change. We have done well with various governments. We means the market for 20 years, and there's no reason why that will stop.
Okay. So I'm going to roll over to 2 very important questions. And Shankar Sharma, what is your big prediction for this Samvat year?
My big prediction is that I remain bullish on small cap companies. I don't think your large caps are going to deliver you anything which is going to beat fixed income returns. So stick to fixed income. If you have large amounts of money, you want to take a bit of risk. The risk spectrum is fairly. In fact, I've rarely seen small and mid caps behave the way they behave. They have behaved in the last 12, 15 months. That even in times of very strong, cuts in the market, they have generally held up very well. And in fact, they have. If you look at just the charts of the 2 markets, the large and the small cap market, they're completely different. You can see big fatigue in the large caps, in the banks. While in small caps, they just fall a little bit, they come back very strongly. And that is really because, smaller companies have growth options which are very narrow, which are very regional. So you could have, your operations in, five states which are doing okay, and, you can suddenly have numbers which are growing 30, 40, 50% because you're a 200, 500,000 crore kind of revenue company. And I see a lot of them. And the other thing that I've found is that a lot of smaller companies are innovating really fast. They're coming up with business models that look very interesting. The large companies have become fossilized, and I think that is the order of nature, that large companies will eventually become small companies, the small ones will become large. So I'm focused really, and my big prediction is that the small and the mid caps are where you're going to make sizable returns even now. I don't think large caps give you anything at all. If anything, there is more downside than upside in the broad aggregate basket of large caps.
So Samir, what is your big prediction for this Samvat year then?
No, I don't have a prediction because I don't think the market is going anywhere, at least in the first many months, till we see substantial change in the outlook for bigger companies across the board. But I think all of them are under attack, either because of competitive pressure or because of government policies or because of new technologies or smaller companies or e-com companies. Therefore, if you want a prediction, I would think index is not going up more than 10% in a year.
So final question to both of you, and Shankar, hypothetically, if we are interacting on the same forum after one year, which is nearly 12 months, what kind of a global environment equity setup, Shankar, do you think we could be staring at?
No, I think globally equities have been in trouble for every single year from 2008 onwards, with a possible exception of 2009-10 when we had this big, rally from the lows. Other than that, I mean, it is a very, very troubled environment for equities. I mean, market returns, and Samir and I have jousted over this over Twitter, that, I mean, for the last 16 years, the US market has given basically less returns than what a US bond would have given. It's like maybe 2% CAGR from the previous high to the current high. I mean, Samir says that you have to keep buying throughout the 15 years. I mean, I say that's a different perspective to investing. But be that as it may, emerging markets flat for 10 years. Japan is never going to go to its highs, at least, in the foreseeable future. Europe in deep trouble. So the equity case itself, despite these kind of rates, has been severely broken. So I think we are on a big, broad macro basis looking down. Equities are in trouble. Within that, we have to find the best. We have to do the best that we can do. Fortunately, in India, I do find, and of course, I buy Samir's argument that as a fund, you can't do what as a family office investment strategy can be. But I find there are significant opportunities in the small and the mid cap spaces. And if you just go back from 2009, there are stocks that are up 50, 100 times. And I see several of them even going out in the future. So I'm focused there. I'm not focused on buying ICICI Bank and Axis Bank. I don't think they are going to go anywhere fast. If anything, I see bigger risks on the horizon for almost all our banks who have dodged the credit bullet on the real estate and infra side. I think the commodity cycle, which has soured in the last 6-8 months, is going to come back and hurt bank balance sheets in the future as well. So I'm sticking to what I've stuck to for the last 12-15 months.
So you think, Samir, both going long and short would be the flavor of the moment? This is not a long-only bull market. This is not a raging bull market, Samir. This market will give you opportunity on both
From an institutional to
sides.
institutional comparison, I'm saying. I'm not comparing a long-short fund with Shankar Sharma finding a 10-bagger, which I hope he tells me offline, not on Twitter maybe. But I'm saying in a general sense, when comparing to index and outperforming it and comparing to long-only guys, this year was very easy. And we hope that, not we hope, but we think that will be the environment for many more months till something changes. Right now, nothing seems to be big enough from either a government policy or global action or, as I said, the attack from the small or the new or the innovative on many of these large caps, many of which we are short.
Gentlemen, it's been fantastic interacting with you. We've pretty much answered all the basic questions which investors they need to consider before they're investing. Wonderful to have you both on the show. Wish you once again a very happy Diwali and a prosperous New Year.
Diwali.
Thank you very much.
Thanks.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.